Hello everyone, in this video, I'll teach you the secrets behind divergence and how to make most of this trading strategy. So what is a divergence? Generally, when a price moves upward or downward, the oscillator should move in the same direction. But when the price is heading in a direction and the indicator is showing a totally opposite direction, then we have a discrepancy. This is called divergence. Look at this illustration. The price is heading upward while the oscillator is showing a downward movement. As a result, the market reversed downwards. There are two types of divergence, regular and hidden. For each type, we have bullish and bearish divergence. So what's the difference between these two types? The regular divergence indicates an exhaustion of a trend and signals a potential reversal, while hidden divergence confirms a continuation of a trend. Look carefully at this chart. You can see that there is a reversal of the trend after a divergence between the price and the indicator. The pair revealed a higher high, but the indicator showed a lower high, which led to this dramatic reversal. This is called bearish regular divergence. Look at another example of a bullish regular divergence. The price reached the lower low while the indicator displayed a higher low, which is an indication of a clear divergence. As you can see, the price was in a downward movement. Then a divergence occurred, and the trend changed direction from downward to upward. This is why it's called bullish regular divergence. Let's move to the second type of divergence, which is the hidden divergence. A hidden divergence confirms the trend continuation in case of bullish and bearish movement. Hidden divergence shows us where the retracement occurs, and it gives a good opportunity for traders to enter or re-enter by catching the main trend. Look at this chart example. As you can see, the price formed a higher low, but the indicator is showing a lower low. This indicates a clear hidden divergence, where the price managed to continue its direction upward after the retracement. Look at another chart example. As you can see, the market made a lower high. At the same time, the indicator is displaying a higher high. Therefore, the price went down after a retracement as shown on the graph. I know that you might be asking yourself, how do I spot a hidden or regular divergence before it happens? So let me explain you how to do it. Take a look at this US dollar British pound 1 hour chart. If we want to predict a bullish regular divergence, we should look at a lower low of the price while noticing a higher low of the indicator value in a downtrend. As you see, after this clear bullish divergence, the market bounced upwards. For a bearish regular divergence, the opposite is true. Search for an uptrend and notice a higher high of the price with a lower high of the indicator value. As you can see on this chart, the market is making higher highs while the indicator is making a lower high. This is a clear bearish divergence. As a result, the market bounced downwards. Let me now show you when to expect a bullish hidden divergence. Look at this chart. As you can see, the price is exercising a higher low, simultaneously a lower low for the oscillator values, and the main trend is moving upwards. Bullish hidden divergence indicates a bullish trend continuation, and that's exactly what happened here. As you see, after this bullish hidden divergence, the market kept going up after this retracement. For bearish hidden divergence, we have a downtrend where the price is indicating a lower high while the indicator is showing a higher high. Alright, let me now give you a quick recap. The regular divergence indicates trend reversals, and there are two types of regular divergence. A bullish regular divergence that indicates a bullish trend reversal, a bearish regular divergence that indicates a bearish trend reversal, and the hidden divergence indicates trend continuation. And there are two types of hidden divergence. A bullish hidden divergence that indicates a bullish trend continuation, and a bearish hidden divergence that indicates a bearish trend continuation. Moving on with divergence, we should know which indicator to use to spot divergences. The most common indicator for divergence is the RSI. The default settings of the RSI indicator is 14 periods. A divergence would help us to spot reversals, continuation, and even an end of a trend. But a divergence alone is not sufficient. You always need a confirmation from other technical indicators and candlestick patterns. To explain how to use candlestick patterns in combination with divergence, look at this chart example. We have a clear divergence between the RSI and the price. The formation of this pin bar candlestick pattern indicates rejection, which means that a reversal is about to happen. So here in this example, we have the divergence between price and the RSI indicator, and we have this pin bar that confirms the trend reversal. Look at another chart example. Here is the Aussie GPY for our chart. As you can see, here is a clear divergence between price and the RSI indicator, which signals a trend reversal. But this is not quite enough to make our trading decision. We still need a price action setup that confirms the trend reversal. As you can see here, the formation of this pin bar confirmed the trend reversal. We can use other candlestick patterns in combination with the divergence strategy, such as the engulfing bar, the inside bar, the doji, and so on. We can move with more advanced techniques using divergence with price action combined with the trend line. So, what we are seeing in this chart is a clear bearish regular divergence between the values of the indicator and the prices. The formation of this pin bar confirmed the trend reversal. But another confirmation comes when the price managed to break below the line of the trend line. As you see in this example, we have three different signals showing reversal: the divergence, the pin bar candlestick pattern, and the breakout of the trend line. Let me now give you another chart example in which we combine three different signals, this time using resistance with an engulfing bar pattern along with divergence. You can see from the chart how price tested the highlighted resistance and failed to break it. As you can see, the formation of this engulfing bar indicates that buyers are no more in control of the market and sellers are going to be in charge of it. The divergence between price and the RSI indicator shows up to confirm the beginning of a new downtrend. My experience in this business says more than 3 signals would complicate your way of trading. Keep it simple, 3 signals is more than enough. Moving on now with the last example of how to use the divergence with other signals and patterns. Here we have a downward trend line where the price failed 3 times to break above it. If we look closely, we notice that on the 3rd time, the price made an engulfing bar touching the trend line. This confirms that the trend line is strong. As well, we have a divergence between the price and the oscillator. This is a green light to show this pair. To end this educational video, I have some recommendations and tips for you. Always keep in mind that divergence alone is not sufficient. You will fall into the trap of fake reversals or continuation. A divergence should be always combined with other signals. Don't ever use two oscillators together, such as plotting RSI and MACD simultaneously. You will end up confused. Maybe one gives you divergence and the other convergence. Another tip, I recommend you use an oscillator on a longer time frame, generally 1 hour or longer. It gives you much more accuracy. Finally guys, don't underestimate the power of divergence. It is one of the most common trading strategies among well-known traders. It is simple and provides very precise results. If you enjoyed this video, click on the like button and leave a comment about what bothers you when it comes to trading and what topics you would like to be covered in our next videos. Thank you very much and see you in the next video.